and welcome to the Roundup, covering what's important to accountants and advisors across the month of October. Inside this month, we're going to have a look at the implications of the ATO's new guidance on ETFs. This is exchange-traded funds. But first up, let's take a look at the ATO's new commercial deals service. Michael, the commercial deals service, what is it, and when would a client contemplate utilising it?
Yeah, well, there are a number of ways that taxpayers and their agents can engage with the ATO. And the ATO in the last month has just provided a little bit more detail on one of those ways, which is referred to as the commercial deals service. Basically, what the commercial deals service is aimed at is taxpayers who've been involved in some sort of transaction. Often it will be a significant transaction that they've been involved with, and they want to basically reach mutual agreement with the ATO on how that transaction should be dealt with under the tax system. Now, when it comes to timing, the way that this particular service works is it's really aimed at situations where the transaction has already happened, but the tax returns haven't been lodged yet. So the thing has happened, you just want to make sure that you've got agreement with the ATO on how the tax rules should be applied before you actually go ahead and then lodge the returns. Now, the reason why a taxpayer might enter into this sort of kind of engagement with the ATO is really just to make sure that there is that certainty on the tax treatment. So if it is an unusual transaction or a large, significant transaction for the client, and they do just want that extra level of certainty before they go ahead and kind of lodge their return with the ATO and make a disclosure, this is potentially one option for them. Now, it's certainly not compulsory. It's not something you have to do, but it's a service that's available, and it's something that the ATO, I guess, is promoting a little bit because there'd be lots of people out there who aren't aware that it exists. Now, when would you maybe consider using this service? Well, the ATO gives some examples of the types of transactions where this might be appropriate. So if you think about things like refinancing arrangements, which are reasonably complex, share buybacks, restructures of a business, or even simply situations where clients have sold significant assets. So that might be a business sale or maybe a property sale, where there's maybe some complexity around how the tax rules might apply, or where the numbers are just significant when it comes to your client's position. Now, what the ATO says is that if you work through this process with them and you then lodge your return based on the agreement that you have reached with the ATO, the ATO basically says that they won't seek to review or audit that particular transaction. Now, it doesn't mean that you wouldn't then be reviewed for anything else. Although, having said that, I would assume that it would look nice to the ATO where you have voluntarily come forward and engaged with them. So I would think that they would probably treat you as a slightly lower risk taxpayer when it comes to kind of other areas, but certainly no guarantees that you won't get picked up for something else. So again, it's not something that's compulsory, but it's something that's there, and it's worth maybe considering when you do have clients involved in transactions that maybe are making you a little bit nervous, or maybe the client's a little bit nervous, and you just want that extra level of comfort before you go ahead and lodge the returns.
So Mike, what are some of the other ways we might engage the ATO to get certainty?
Well, a lot of taxpayers and agents will be familiar with the private ruling process, so that's certainly something that you can consider. Private rulings in some ways are reasonably flexible. You can seek a private ruling before something happens, although the ATO probably wants to make sure that it's something that you're at least seriously contemplating. Or you could seek a private ruling afterwards to have some certainty again before lodging a return or making some sort of disclosure to the ATO. Now, private rulings, the ATO does try and turn those around within about 28 days, although I think anecdotally it certainly sounds like the ATO isn't necessarily hitting that target at the moment, certainly not across the board. It seems like wait times for private rulings are a little bit longer at the moment than maybe what they have in the past. And that's possibly just a function of lots of people wanting some certainty and wanting to engage with the ATO and just kind of reduce the level of risk that they have before lodging returns. But aside from private rulings, there is something else that clients, again, who are involved in maybe unusual or high-value transactions might want to consider, and that's engaging with the ATO before a transaction has occurred. And we refer to that as the early engagement process. So a completely separate process, separate email address, separate forms that are used to basically start the process off. But the early engagement process is really aimed at those taxpayers who are contemplating something that might be complex or unusual or large dollars involved. and want some certainty on the likely tax outcomes and the issues that they're going to have to consider before the transaction actually occurs. Now, timing-wise, you'd probably want to begin that process earlier rather than later, because sometimes these things do take a bit of time, particularly if there's a bit of complexity involved. But it is another thing that's worth just keeping in the back of your mind. It wouldn't be suitable for every client scenario, but it's something just to be aware of. So lots of different ways that we can potentially engage with the ATO. You may well have clients who are completely against all of these ideas. They don't want to engage with the ATO more than they really have to, but there will be other clients who would actually value that. At least being aware that there's an option and being given the pros and cons of those options so that they can make an informed decision. So for those clients who might be a little bit nervous, who might kind of want to sleep better at night, there are definitely some things that can be done. There are ways you can engage with the ATO and different options in terms of pre-transaction or post-transaction.
Also from the ATO this month is the new guidance on ETFs. And what is an ETF and how is it taxed?
Yeah, so an ETF, or an exchange-traded fund, is a managed fund where units in the ETF can be bought or sold on a registered exchange, such as the ASX. ETFs invest in various underlying assets, which could include Australian and foreign shares, property, bonds, etc., or can be indexed to certain markets. Essentially, this means that investors can be exposed to a diversified portfolio of assets by just holding units in one ETF. While investing in ETFs is often likened to investing in shares, the tax treatment is actually quite different because ETFs are considered to be trusts, which are tax-transparent entities. So unlike companies where tax is paid before dividends go to shareholders, for ETFs, it's generally the pre-tax income that is taxed in the hands of the investors. The ATO website guidance clarifies that there are three main taxing points for ETFs: when you receive a distribution, when your distribution is automatically reinvested, and when you sell the ETF units. So when you receive a distribution of income from an ETF, this is treated as a trust distribution, which represents a share of the income earned by the fund. Depending on what the fund invests in, this could mean that the distribution can be comprised of many different types of income, such as dividends, franking credits, interest, foreign income, and capital gains. Each of these various items will need to be separately disclosed in the tax return with the correct labels. For Australian ETFs, there should be an annual tax statement provided by the fund, which will have a breakdown of the various income types and also the appropriate labels where they should be disclosed in the tax return. However, for most foreign ETFs, they won't have a similar statement, so it's important that the distributed income is manually reported correctly under the foreign income section. Sometimes there will also be foreign income tax offsets or foreign tax credits for withholding, which can reduce the overall amount of tax payable.
So, Anne, what happens if a client's distributions are automatically reinvested?
Yeah, so it's also relatively common for ETFs to offer distribution reinvestment plans, or DRPs, where instead of receiving a cash distribution, the income is automatically used to purchase extra units in the ETF. When it comes to the tax treatment, even when distributions are reinvested, the distributions are assessable in that year as if you received a cash distribution. This is because general trust income rules apply. Trust distributions are assessable in the income year they relate to and not when they are paid. It's also important to keep a record of what price each parcel of the new units were reinvested at, so that you know the cost base when the units are later sold. When units in an ETF are sold or disposed of, the capital gain or loss will need to be included in the tax return for that year. The capital gain or loss on disposal is normally not included in the annual statements from the ETF fund, so it's something that will be separately calculated and then included. When you're calculating the cost base, you will need to identify which units are being sold, as well as check the annual statements to see if there have been any cost base adjustments. And also the general CGT discount can also apply if the client has held the units for over 12 months. And lastly, in the recent website guidance from the ATO, they have recommended that clients keep records of the ETF investments for 5 years after the tax return has been processed. And that's the roundup for this month, short and sweet. We'll look forward to talking to you next month.
But in the meantime, if your firm is not a member of Knowledge Shoppers yet and you'd like to experience the workpaper knowledge base, the hugely popular help desk, the client newsletters, and so much more, just give the team a call on 1300 378 950. We'll love to show you what a difference we make to professional accountants and advisors every single day. Talk to you soon.